higher ed. It's a space that's been under attack for the last year, and its business model is being upended. How is this affecting your role overseeing the endowments and how you think about managing that pool of capital? Amy, let's start with you.
Sure. Definitely business models are under scrutiny. We are about 25% of the university's revenue. One thing I'd say that's important, higher ed is often lumped together, but actually the business models are quite different across different universities. So there are universities with much higher endowment support. The flip side of that is we have had relatively high research support, government funding. We have sports funding. So everybody looks a little different.
But does this make sort of the endowment piece all the more important?
We cannot slow down because we're a very important source of independent revenue. And also, we need to preserve liquidity because the operating model is more uncertain. So we have an unenviable task of generating higher returns, but also having more capital available as needed. So that can be tricky.
Jane, how do you see things?
Right. I mean, I agree with everything she said in the sense that we are under a lot of pressure in terms of the business model. We are required. We are 19% of the operating budget, so not as bad as, say, a Princeton or a Harvard, which are over 50%, and that is quite challenging. We also have a lot of research funding, so that puts our business model under pressure. We do need to ensure that we continue to have high risk-adjusted returns, but nevertheless, we need to have liquidity to ensure that we can backstop the university if there's any issues.
So have you had to adjust your portfolio at all this year, given the liquidity needs? I mean, what have you had to do?
I've actually raised some cash. I think we've been pretty clear about that, which in a very up market, is not the ideal thing. We've tried to barbell a little bit, so we have a little more cash, and we're continuing to drive towards higher return asset classes. But it is trying to hold two things that are usually in opposition. Liquidity generally is a good thing, but you get paid for illiquidity. So we're just being very, very intentional, and it helps to have rates a little higher. It's not as painful as when cash yielded zero, but it's we're very sharp pencil about what we think we need, where we can get liquidity, and how to make sure that we're exactly on that edge.
Yeah.
Jane, what about you? Are you also holding more cash these days? Or
well, the first challenge is that our private portfolio has been cash flow negative for about 4 years now. So that has put already a significant amount of pressure on our liquidity. So we try to hold about 12 months of cash available, and that is just ensuring that we always have that extra cash, and trying to figure out where we're going to get it has always been the challenge.
So I wanted to drill deeper into the private sort of portfolio. I mean, as you said, a lot of cash liquidity issues there, but at the same time, you're under pressure to increase returns. So, I mean, Amy, how are you thinking about that portion of your allocation?
I mean, we still believe in higher returns in private asset classes. I think there are two components to that. One is the middle market and smaller to mid-sized companies, which I think has been said a number of times. The public markets have gotten more and more narrow. So ironically, retail is coming into private equity. Private equity is becoming more publicly available, so it seems like a big circle. But we still believe that companies in the middle of their life cycle, not huge, not tiny, are a great place to invest because it's easy to grow earnings. And that really, you kind of got to go through. There's a lot more opportunity via private equity, and of course, venture capital and innovation. So we got to stay there. But there's no question that the distributions have been low relative to current NAV for the last 3 to 4 years. So you model what you expect, then what you expect doesn't happen. You have to kind of
Have you been active in the secondary market? Or?
We've sold a little bit in the secondary market. We're more in the real asset space. I think the flip side of a lot of liquidity, retail money coming in and big evergreen funds, is there is more liquidity in the secondary market, and I think that is helping. But you usually, you got to be careful, and the pricing is erratic.
Jane, how about you?
So we believe that you can generate 300 to 400 basis points of outperformance from your private portfolio. So we've actually built a relatively large private portfolio. That unfortunately has not been the case for the past several years. That's been a
Are
little
you
bit,
changing anything
that's a little
then, or?
painful. I mean, we're long-term investors. We're always trying to think what's happening 10, 20, 30 years out. So I think it's hard to know. First of all, it's unknowable. We do believe that still holds true. It's hard to continue to see how the markets can have these returns that they've had. We said that after the first year. We said that after the second year. Now we're in the third year, so it continues to. We'll see what happens next. And then in terms of trying to find liquidity, we're looking at all sorts of different ways, and absolutely looking at the secondary markets. Everybody's looking for lots of different ways to do it, whether it be NAV loans, secondary markets, et cetera. The secondary markets have continued to become much more liquid, which is fantastic. We hope that continues to improve, and that will just make, I think, these trimming and pruning of portfolios just much more efficient and effective, just even on doing it on a regular basis.
How do you see the push towards retail and sort of democratization of PE changing the industry?
Yeah, more money is usually doesn't drive returns higher, right? So if more capital comes into a space.
Well, probably good for us, but maybe not good for.
I think it may shift where we focus. So my expectation is the retail money will come in at the higher end of the market in terms of larger funds, bigger deal sizes, which may mean we migrate down to middle market and even lower middle market. The one thing I would also say, though, is we talk about liquidity as you get money, but public markets also set prices. And I think it's really important that price discovery is really done by public markets. And the more thin the markets get, the more narrow the markets get, the worse, I think, the broad-based pricing. And then privates are a derivative of public markets. So I think it's really important that the public markets stay robust and healthy, and capital coming out of public markets going into private markets will make them more money, but it's not clear to me that that really helps the pricing of risk.
The concept of this, private markets being derivative almost seems to be becoming more and more disconnected.
Yeah.
You're seeing some of these companies trading at, 26 times revenue. I mean, how does that make sense? And you're just kind of, when those actually go public, are you actually going to get paid? And we're starting to see the public markets opening up a little bit. And so some of them actually go up, some of them actually don't go up, and they're trading below their last several rounds, and that's actually tricky.
So zooming out a little bit, I mean, you both invest across the globe. I mean, as you look at not just private markets, but public markets, I mean, how are you viewing, and particularly the U.S., given the run-up that we've seen in stocks, how are you thinking about the U.S. versus the rest of the world within your allocations?
Do you want to go first?
So we... So first of all, we invest primarily through managers, and we're thematic investors. So it might be a geographic theme, or it might be just some sector theme, whatever the case may be, and wherever that sector plays out. But one of the things we talked about this morning was the corporate revolution in Japan. That's been interesting. So we would spend time talking to different managers in Japan and finding out what parts of the market they're playing and whether that might be something interesting for us to do there. Those are the types of things.
Any other sort of emerging markets that you've dabbled in, or?
We've done quite well in Argentina.
And what have you been doing there?
We have a manager who's done a lot of credit in that space and been very successful for us. So that's worked out.
What about you, Amy?
I mean, we're pretty committed to staying global. Interestingly, the U.S. markets are up. The dollar's been a little weaker, so it hasn't been all bad to be outside the U.S. this past year. I think as an equity investor, we're looking for earnings growth. And I think there will be good growth in other parts of the world in addition to the U.S.
Which ones in particular are you looking at?
It's interesting. We've been mostly focused on Asia, Japan. I think Europe has a lot of potential. It's not as highly valued as certainly the U.S. And I'm intrigued with emerging markets and places like Africa and the Middle East, which have, that's like probably not going to be a huge percentage of the portfolio, but the demographics are positive in many ways. There's a lot of infrastructure potential. So there's a lot of risk, unquestionably, and especially in Africa with debt burdens as high as they are, it's a little tricky. But I think we are very long-term capital, and we should be able to at least be looking at parts of the world that, may have their time in this proverbial sun.
Mm-hmm.
One of the things we're concerned about, though, is when you said demographics, right? Yeah. And I think one of the things as we look at this AI revolution and robotics, that may actually turn everything on its head, right? So where once we thought that India had this great demographic story, maybe having a larger population could be a problem, and having a smaller population or not a growing population like a Japan might actually benefit from robotics and AI in advance of some of these larger countries, higher population countries.
What about, I guess, U.S. public markets, and particularly, the Mag 7? I mean, how are you thinking about navigating investing in, the biggest market in the world?
Yishen, who was here, is on my board. And I have real, in some ways, concerns about the growth of passive investing, in the sense that, capital allocation happens when people make decisions about where to invest. On the other hand, I have found that we're structured, as an endowment with active managers, most of them are not as long the obvious Mag 7. So what I've found is we're kind of tend to be structurally short those kinds of names. And a way to address that is through index funds. So I think...
Have you been doing more in the
We've been doing more of that. I mean, I'm going to say we're indexing the whole portfolio, but at the margin, to have a plug in a highly liquid, low-fee vehicle, I think it has been not a bad idea in particularly large cap where the spread, it's really hard to beat the market. I've seen statistics that even the average endowment, let alone the average fund, it's really been hard to beat large cap, the index. Now that could change, and I do think higher rates make, it's less of a rising tide, and the boat matters. But I think for some purposes, just keep it simple. These are big companies, and active managers, like you're not going to pay someone $220 to buy Google, so they just feel like that's not adding value, and probably isn't. So,
I mean, I think we're all dramatically underweight the Mag 7 because of that, because of our managers and they not investing in those big companies, and so that's been a problem for a lot of our returns, I think, for the past several years. The way we address it is by, again, this thematic thinking, and if it's, if we think the hyperscalers are really important, then we would maybe add exposure specifically to them. So that could be those, some of those businesses, or if we're really focused on our AI theme, adding exposure just directly, and kind of overweighting those because we're so underweight. Mm-hmm.
I mean, so we've talked about your sort of investing and return goals. I wanted to ask how you think about balancing that mission with calls for increased transparency around the endowment, particularly around sort of political, ethical lines, including calls for divestment in some cases. Jane, do you want to take that? Yeah.
Sure. So we sign agreements with all of our managers that they don't disclose our name and we don't disclose theirs. And so, when the students come, and not just students, but whoever asks to understand what's in our portfolio, that's
and
not
you've
really
engaged directly with them. I mean,
yes. We had dozens of meetings with students, alumni, staff, faculty over the past several years, basically trying to explain what an endowment does, since I think most people don't really understand how they actually work. And then, they are obviously asking for transparency about exactly what we're invested in, which we cannot give. But there's this assumption, because we don't actually give direct names, although you can 13F our portfolio, you can see our direct names specifically. We always show people, and we show the students, here's how here's how you actually run a 13F, here's how you see what we have that we own directly. You'll see that, and then you'll know that we're not actually investing in, I don't know, genocide. They're always like, you're investing in genocide. I'm like, why would you think that's something that we would do? I mean, that's an interesting, just that assumption is strange. But so we do try to engage and we try to communicate. We try to use it as an opportunity to explain who we are, what we do, how we're not different from them, how we actually have values, ethics, and how we try to utilize that as we make investment decisions on a daily basis.
Amy, how are you thinking?
Well,
about
I think,
transparency?
first of all, Brown's done a great job, so we've copied a lot of what they've done. But I think engagement is critical. We are educational institutions, and meeting with students particularly, but also faculty is important. We are also competing in a very difficult space, so we're not going to disclose everything. But I think focusing on the values and the purpose of the endowment, and helping to reassure people, students particularly, that we're not just willy-nilly without any ethical lens. The other thing that I find interesting with the younger generation is their theory of change. So what do you want to see happen? And are the capital markets the best way to effect that change? This was very evident in the climate discussion. And often students benefit from taking a step back and trying to think, is a public policy is the government a better actor in this space? Is divestment the best tool to achieve what your goals are? And even what are your goals? So I find that conversations can be quite robust, but the kids turn over every year, so it's just inherently a constant thing. But
is that sort of going to be part of your lives?
That's your job. Yeah, I mean, these are young people and a lot of young women, and I feel that we are role models. And I teach a class. I mean, it's a great space to meet kids and talk to them, and they're passionate and they're not disingenuous. I mean, they care. It's good they care, but just help them think what's the best way to express that concern.
And they often want us to divest of stocks. They give us these lists of stocks and it's like, we actually don't own any of these stocks. But that's actually not what they're trying to achieve for the most part. They really want the university to make a public announcement that they're trying to make a public statement, and the university's not going to do that. And so this is kind of their approach to getting that done. But I think most of the discussion, as you said, is like, if you actually believe that this is important and you want to actually make change, this is probably not the place to do it. You need to go to Washington, talk to your congressmen, talk to their senators. That's actually what they're there for.